Hello, everybody. We're just testing our audio. If you can hear me, please give us a thumbs up. Thanks. All right, well, welcome, everybody. I think you can hear. Now, it would be great to see if, or it would be great to know what state everybody's in. Can you see the screen as well? So we're just checking our audio, checking our screen. In the meantime, please let me know what industry you're in, what state you're in, and we'll get into it in 1 minute. All right, great. So we'll begin now. So today's a little bit more of a technical presentation than what we would normally deal with. And the reason why it's a little bit technical is we're doing more information about corporate structuring, insolvency, and looking at 2021 and looking at the pitfalls that people had during COVID and how to try to correct those. So my name is Damin Murdock. I'm a solicitor, been a solicitor for more than 10 years, founder of a law firm called Murdock Chain Legal Practice based in Sydney. We have an office as well in Melbourne, and we work closely with LawPath. Today we're going to talk about what your corporate structure looks like, how you can protect your assets, what a related party transaction is, and how that becomes relevant in the event of an insolvency. If you have a standard structure, whether it's time to now consider restructuring your business, and how do you do that? And the common theme that we get a lot of questions about daily is how to issue shares to employees and consultants and what method to do that. Then we talk about how you're going to recover your debts if there's companies that are owing to you, that owe you money, general insolvency, and something called deed of company arrangements, which might become relevant. Now, we do like everybody to ask questions as we go, and as we go, I'll try to answer those questions. And if I don't do it while I'm presenting, then I'll answer your questions at the end. Now, most people, when they create their company or their corporate structure, they keep it very simple. And by doing that, they just create a PTY Ltd company. Now, a PTY Ltd company, it basically means it's privately owned, and the shareholders, their liability is limited to the amount paid on their shares. So oftentimes people will go and they'll log into LawPath and they'll incorporate a brand new company. And on occasions, we do see people wanting to issue a lot of shares in their business because if they have a lot of shares, they believe that it will make it look like it's a bigger business. And they also might issue those shares for $1. Now, what that means is that you're then liable to the company for $1 million. So if you issue 1 million shares for $1 each, your liability is $1 million. And the reason for this is that a shareholder's liability is limited to the amount of paid up capital on their shares. So normally when you create a company, you should probably be doing about 1,000 shares or 10,000 shares for 1 cent per share at the very beginning. Otherwise, in the future, if you did issue 1 million shares for $1, and if your company is placed into liquidation at the end of the day, then there is a situation where the liquidator could come after the shareholders for any unpaid capital. So we have a couple legal proceedings on foot dealing with this. And so I wanted to start out with this just to make sure that I tick this box. So if anyone did create their company in this method, you want to have a double check and make sure that the number of shares that you've issued to yourself and the amount that you've recorded with ASIC has actually been paid into the company bank account. And if not, you can make a correction. Now, the question is do you need to restructure your business? Is there a reason to have anything more complicated than what you have now? For 85% of the businesses out there, standard PTY LTD is probably the right choice, and it's probably the standard choice for most companies. However, it depends on what you're planning on doing with your business. If you're a consulting business and you're just doing general consult, then this is probably the right structure. But if at the same time you're doing general consultation and you're also developing a technology, then it might be a situation where you want to put your technology or your IP or your software or your trademark and your business name and trading name into a different entity. This is, in a way, an asset protection, so that if anything happened to your consulting business, you could then liquidate your trading company and not lose the domain name, the business name, the trademark, the software that you've developed. Now, if you're planning on selling the software separately, then you want to also consider from an accounting perspective and also from a tax perspective, whether it would be appropriate to put that software into a separate company so you can sell just the technology but continue on with your consulting business. And I'll get to that in a moment. So should you restructure? Should you consider that? So this is the standard structure that most people have. They'll have 2 shareholders, 3 shareholders, and then their standard trading company. The trading co enters into all the contracts with their customers. The trading co employs all their employees, and you go about your day. Now, what happens if someone sues you? Well, that company could go into liquidation, and as a result of that, you're left with a company that might have had some assets, but at the end of the day, the liquidator's taking control of them, and you lose your business. Now, before we get into creating different entities, we'll also look at just family trusts generally. I'm sure a lot of people have heard of a family trust or a discretionary trust. And this is the general structure of what you would see when you have a family trust. And that is that the shareholder 1 and shareholder 2, they hold their shares on behalf of the trust. And what that means is that when Trading Co. has a profit, that profit is then distributed to the shareholders. And this would then give you flexibility to now distribute into your trust, and your trust would then distribute to the different beneficiaries. So if, for example, you're on an $89,000 salary and you're in one of the higher tax brackets, and Trading Co. issues dividends of $100,000, then once that dividend goes into your trust, you would then pay yourself another $100,000 and pay tax on that. However, if maybe you have a partner, then you might be able to distribute that dividend to your partner in your family trust, which would ultimately reduce your tax. Now, I'm not going to get into the tax effects or anything like that. This is more a high-level structure course on just getting an understanding of what is out there for you to inquire further in the event that you want to consider doing a restructure. So when we look at asset protection, we look at if you have a holding company above your trading co. So if we look on the left-hand side, we have your standard structure, but you have a trading company underneath your holding company. And in this circumstance, Trading Co. would be entering into all the different transactions but the IP is actually owned by holding co. And the reason for that is that if trading co was to be sued, then you would be able to close down trading co, start again, and have all the IP held by holding co. Now, if you offer two services, for instance, if you have a look at the right-hand side, you have the holding co, and then to the side of the holding co, you would have an IP company. Or alternatively, underneath the holding company, you would have your Australian arm, your New Zealand arm, your IP company, your US arm. So if something happened to your New Zealand business, you would just close that down, but it wouldn't affect your Australian business. Or if something happened to the Australian business, it wouldn't have any effect on the technology that you own. So again, all I'm doing is raising the different kind of structures that exist so that if you do want to consider protecting your assets, this is probably a good starting point. Now, there's something called related party transactions. So if we were to go back and look at the situation where the holding co owns all your IP and the trading co is the one that enters into all the different contracts, then you want to be licensing your software down to the company that's trading so that the trading co doesn't actually own the IP, but it's commercializing the IP on your behalf. So if something happened to trading co, then you could claw back all the IP back into the holding company and then start a brand new company again. Now, this is what we generally would call asset protection. And to do that, you want to consider whether you're lending money to your company or whether you want to hold your assets in a separate entity. So during COVID, there were a lot of different companies that went under, but a lot of those companies might have just been trading companies and they might not have had any actual assets. And that's because they would have structured it in a way that all the contracts that they might have entered into with your business was their trading entity, but all their actual assets was held by another entity. So the question I have is, are you guys injecting money into your company? You personally or through a holding entity? And if you are, then you want to be getting a loan agreement in place. And you want to be considering getting a loan agreement or a facility agreement plus a general security deed. Now, what I mean by that is that a loan agreement is a lump sum payment. So I'm going to inject $10,000 in my business. So I'll enter into a loan agreement and I'll sign off on that loan agreement and I'll transfer $10,000 into the bank. Now, if you regularly invest money or put money into your company by way of a loan, and it's just to pay bills regularly or as the money is required, then you can enter into a facility agreement. The facility agreement essentially says, we're going to make available up to $100,000 available to your business as long as you do not breach anything. And as you request the money, we will then transfer the money to you. And so that's a facility. So you're making the money available, and as you require it, you draw down on that $100,000 amount. So if we go back to a situation where you have a holding company and you have a trading company, your holding company would have a loan agreement with your trading company or a facility agreement with your trading company, lending money into the business. But what you also want to do is do what's called a general security deed plus a PPSR. Now, a general security deed means that you are taking a security interest against your trading company. And I know all this might be quite complicated, and you might not know where I'm going. And that's all right, because we will be moving on to other issues shortly. I just wanted to start with this so that it can trigger maybe your interest in possibly considering restructuring or protecting your assets. Now, in terms of a general security deed, it essentially says, I'm going to lend you money, but you're going to sign this document. In this document, called a general security deed, it grants me a charge against the business. it enables me to register a charge so that I'm a secured creditor against the business. And to show that I'm a secured creditor, I'm going to register a security interest, which is under the Personal Property Securities Act, and it's called a Personal Property Security Registration. Now, this will be available later, so there's no problem if you have to go. Just answering Jason's inquiry. Now, if you were to buy a motor vehicle, for instance, and you buy a car and you get finance on that car, and then you don't pay the financier, and then you go to sell your car, anyone that does a search on your vehicle will see that there's a charge lodged against your car, held by the person that financed that vehicle. This is very much the same, whereby you lend money from your holding company or from your family trust to your trading company. And then once you lend that money, you register a charge which shows up on ASIC and it shows up on their personal property security register. So in the event your company is unable to pay its debts when they came due, and if your company ends up going under, you're in a situation where you're a secured creditor and you can defeat everybody else who you entered into business with. And this is because pursuant to section, or pursuant to the PPSR, it is deemed an unrelated transaction in many respects because it is a secured interest, which I'll get into in a moment. Now, if you were to lend money to your business and if you're looking to invest money or have an investor invest into your business and you have a charge against your business, then it might be difficult to raise capital for investors to convince them to invest money into your business if they know that your business has a debt. So oftentimes we'll create other things such as convertible notes or something else to deal with that debt. But these are I'm just trying to trigger your interest so you know that this kind of, these documents exist and what they're actually used for if you've ever come across them. Now, we're talking about having your assets held by a holding company or held by your family trust and then licensed down to your trading company. This is by way of a license agreement, and essentially what you say is, I'm licensing all the IP down into my trading company. My trading company might build upon my software, or my license company might, or my trading company might add value to my software by commercializing it, doing advertisements, promoting it. But if at any time that trading company commits an act of insolvency or commits a default event, then your holding company will be able to claw back all the IP, terminate the license agreement, let the trading company go into insolvency, and then start up again later under a separate entity. But you have to be aware of section 588FH of the Corporations Act. So if your company cannot pay its debts as they come due, a liquidator is appointed, they can take control of all your assets. Their responsibility now is to look at what your company has, consider whether it can sell your business, sell your assets, collect all the assets from the sale proceeds, and then distribute it to the secured creditors, then to the creditors, and then to the shareholders if there's anything left over. However, if you have a license agreement and you don't have a personal property register or a PPSA registered to confirm your license agreement, or if you've loaned money and you don't have a PPSR registered against your company, then the liquidator will see that as a related party transaction. And a related party transaction is voidable. So that is that if it's a transaction that appears to be unfair, or if it's a loan that seems to be unfair, or if it's a director-related transaction, then normally the liquidator will be able to stop you from clawing back your IP, or stop you from clawing back your loan money because it's a related party transaction. However, the Personal Property Securities Act actually defeats a liquidator. So it actually says, yes, it is a related party transaction. However, the Personal Property Securities Act entitles me to overcome this related transaction issue because I've become a secured creditor and I've perfected my loan and I've perfected my license agreement by registering a charge against the business. And because of that, I actually am superior to anybody else. And liquidator, you do have to pay me back first. And liquidator, I can take back my IP because I perfected it by registering a charge. And the general nature of a perfection of a charge is that you have to register it with the PPSR within 21 days from the transaction being entered into. So that's all I have really on the asset protection side of things. I just wanted to raise that with you because it has been very relevant over the last year with COVID. There's been a lot of companies that have gone under, and those companies that properly structured their business have been able to close down those businesses, and then they've been able to come out of that and start again, still maintaining a lot of what they originally had in their holding companies. Now, there's something called a rollover. So if we go back to these structures again, let's say originally when you started up your business, you're the standard structure, you're just a trading co. And let's say you now think, well, maybe I should actually be putting a holding company above my trading co. So I've listened to Damin's seminar. I'm a little bit concerned that there is some risk in my business. How do I actually squeeze in a holding company above my trading company? And so effectively what you need to do is let's say shareholder 1 and shareholder 2 have all of they own the shares in the trading company. What you need to do to squeeze in a holding company in between shareholder 1 and 2 in the trading co is you need to sell all of shareholder 1 and shareholder 2's shares in trading co to the holding company. And then when you incorporate the holding company's shareholders will be shareholder 1 and 2 in the exact same shareholding. So let's say shareholder 1 and 2 were 50-50 owners of trading co. Shareholder 1 and 2 would then sell their shares to holding co. Holding co would become 100% shareholder of trading co. And the new shareholders of holding co is again 50-50 shareholder 1 and 2. You would then look to transfer your intellectual property up to your holding company and then license back your technology down from holding company to trading company. And that's where the license agreement comes into play and the registration of the charge in favor of the holding company over the trading company. Now, when you sell shares, when you started your trading co, you might have incorporated with 1,000 shares for 1 cent a share, and now your business is worth something, and you can't just sell your shares for nothing because they're now actually worth something. So you might be selling your shares to holding co for consideration for an amount. However, there's something called a rollover. So if the shareholder 1 and shareholder 2 were both 50-50 of trading co, and then a holding co becomes 100% holder of trading co, and shareholder 1 and 2 are now gifted shares in holding co, that means there's no capital gains tax effect. Because even though you're gaining a benefit, even though there's a transfer of shares or sale of shares and the issuance of new shares, which would normally trigger capital gains, there is something called a rollover. And a rollover is basically where you restructure your business and the shareholding has gone from one entity and it's transferred into another entity. So if you're looking at doing some kind of structure, there could be a tax effect, and you need to make sure that your rollover provision will be properly dealt with, and you hit all the different elements in that restructuring so you don't get hit with a capital gains tax. Now, we get a lot of questions about issuing shares to employees and consultants, and a lot of people want to issue shares to their employees or consultants, or they're just a startup and they don't have any money to pay an employee. So the regular question I almost get daily is, we don't have any money to pay our employee, so we want to give them sweat equity. We want to give them shares in our business instead. Now, you have the Australian Fair Work Act, and you also have the minimum wage requirements, and you have modern awards for the different industries that you're in. And there's no law that says that an employee or that an employer can pay sweat equity instead of actual salary. Everything throughout the Fair Work Act is you must regularly pay the minimum wage or the award wage within 14 days or 30 days. You have to pay annual leave entitlements, public holiday, sick leave, and so on. So there's nothing that allows an employer to simply just issue shares instead of paying a salary. You would be in breach of many, many, many sections of the Fair Work Act, and also the minimum awards or the award rates. So how do you actually do it? And the way to do it is probably making them an independent contractor. So if your business doesn't have enough money to pay an employee, then you shouldn't be making them an employee, but instead you should be making them a contractor. Alternatively, you can make them a director. If your business is small and you're looking at putting on someone as a director, then there's no requirement for that director to be an employee, and that director can get shares or for compensation, to be compensated for the services, or they can also get paid director fees. Now, the three common ways of issuing shares to employees is pursuant to an employee share option plan, pursuant to an unregulated option agreement, or what's called reverse vesting. So I'll go through these just generally so you know the existence of them. Now, in 2015, there was new legislation that came in to deal with employee share option plans. And essentially it says that an employer can issue options to an employee, and that employee then holds those options. And when there's an exit event, or when those options convert into a share, then they will receive up to a 50% tax concession when it comes to capital gains tax. So I'll just explain that briefly. So an employee share option plan is basically the governing rules in how you deal with these options. And an option, similar to an option on a property, is you're giving someone the option or the opportunity to take up shares at a later date or buy land at a later date. So you're giving an option to someone, and that option will normally have certain conditions. And once those conditions are satisfied, they can then convert into a share. So let's say, for instance, you have, just to use easy numbers, let's say you have 90 shares in your business. One founder has 45 shares, the other founder has another 45 shares, and you want to offer your CTO or someone 10% of your business. You would then create an employee share option plan, and you would create a letter of offer. And the letter of offer would not say, we're going to give you 10% of the business. Instead, it would say, we will give you 10 options. Because at the time of the grant of the options, if those 10 options convert into shares, that means that there'd be 10 more shares, which would mean that there's now 100 shares in the business, being the founder holding 45, the other founder holding 45, and this new employee holding 10. And so that's how they would be getting the 10%. But never, never, never offer an employee a percentage of your business. Always offer them the number of shares that would, or the number of options that would reflect that percentage. Because otherwise, you will be having a dispute on whether it was 10% at the time the letter of offer was made, 10% after you issued shares to an investor, 10% at the time that the options vested, and so on. Now, what does vesting mean? How does an option convert into a share? Well, normally you would say, we will give you 10 options. Those 10 options will convert into shares, but you have to work in the business for a period of 4 years. And at the end of each 12-month period, we will convert 25% of those 10 into shares, or we'll give you the ability to convert them into shares. And that means that they've invested. So you have 10 options. They are going to vest into shares, and each year they vest. Now, at the end of those 4 years, they've all vested. And normally that you would think that would mean, well, now they're entitled to shares. But under the employee share option plan, you normally are in a situation where an employee is not given the right to actually convert their option into a share. They're only normally given the right to convert an option into a share at an exit event. So what that means is that you issue 10 options to an employee for 1 cent each. You then are going to sell your business for $1 million. 10% of that million is 100,000. And so that employee will then go and pay the exercise price of 1 cent per option. So they end up paying 10 cents. And then 5 days before an exit event, and then you have an exit event, and they get paid $100,000 from the purchaser of the business. Now they then have a capital gains tax between the price that they paid on those options and the price that they've received for those shares that had converted. And under the employee share option plan, you have the benefit of them getting the 50% tax concession. There's a bunch of different rules that apply, so you got to make sure you follow those rules, such as the size of your business, how long you've been trading for, whether you've taken an investment, how long employees held those options, things like that. But I guess the benefit is that if you want the employee to benefit from a good capital exit with a good tax concession, then employee share option plan is the good option. The other benefit is that as an employer, you're actually not giving an employee actually shares. So they're not a shareholder, which means if they were to disappear and you have an exit event in 6 years, then you're in a situation where you're not having to deal with that person over a 6-year period and getting them to sign documents as a shareholder and having to find them and getting their approval and things like that. Because it can be quite tedious to find people who are no longer employed with you and getting them to sign documents to approve certain shareholder matters. The next one is just doing an option agreement. It's just generally, it's not regulated. There is a possibility of an income tax liability. There's no real capital gains tax concessions normally, and they convert upon vesting. So let's say you have a board member, or let's say you have an advisor and you want to give them 1% of your business. Let's say you have 99 shares, you'll give them 1 option. And as long as they attend to your board meetings every month, then that 1 option will convert into a share at the end of the year. And that means that at the end of the year, you will actually issue them 1 share and they will become a shareholder. And then once they become a shareholder, they will be entitled to dividends, they'll be entitled to vote, things like that. Now, what you need to be careful of, though, is income tax liability. If you were to hire, let's say, a CTO, a developer or someone like that to build your business or build your software, and you say, look, normally you would receive $100,000 or normally you would receive $150,000 salary, but I'll tell you what, we'll give you $100,000 salary and we'll give you $50,000 worth of options. If you've actually put a value on those options, then once you give those options and they convert to a share, they're getting value for services rendered. And that means that that's an actual income. And they'll actually have to pay income tax on the value of the share that they've received, even though they haven't really received any payment from you. So you have to normally draft an option agreement so that it doesn't tie in with income, and it's more about loyalty. You have continued to work in the business for X period of time. We are very loyal. We're going to reward you with loyalty, but we're not going to give you options for exchange of services or exchange for salary. And then the last one is reverse vesting. This normally is for founders. So if you start a business and let's say 3 founders go into business together, and when they do go into business together, one's going to be the marketing guy, one's going to be the CTO, and one's going to be the business development manager. And that's, you've given each other 33% of shares each. And the reason for that is on the presumption that you're all going to work in the business full time. But what you normally see is maybe the CTO, the tech, it needs to be built first. So the marketing manager and the business development manager will keep their job. They won't start in the business just yet. The CTO will quit their job and they'll work full time in the business. And then once they're working full time in the business, once revenue starts coming in, the other 2 will quit their job. Now, sometimes there's a substantial delay in the development of technology, and that CTO is stuck doing everything, and the other 2 parties are doing nothing. Or it might be the case that you have 3 people and one of the person dies or moves overseas, or no longer working in the business. If that's the case, then you have 1 or 2 people working in the business and someone else not pulling their weight or doing anything. And you're stuck in a situation where you're now running a business with a 33% shareholder who's doing nothing. And that's not really fair. So you have what's called reverse vesting, which says, we're going to issue shares to you now. However, when we issue you these shares, it's working on the presumption that you're still going to be engaged in the business actively, and you're going to be working in the business. And if at any time during these 4 years, you stop working in the business, or you're terminated, or you resign, or you die, or whatever it might be, then you get to keep the shares that you've earned. So let's say it's 1 over 4 years, then they earn 1 divided by 48 of their shares every month, month on month. And let's say they resign at 6 months, they get to keep 6 divided by 48 of their 33% of the business. Then the other portion gets clawed back. And that either gets clawed back by transferring those shares to another shareholder or canceling them. So that's what reverse vesting is. And then the question is, well, how do you actually enforce that? And you normally grant a power of attorney to the board to sign any document to claw back those shares. So that's what the reverse vesting is, and that's the 3 main ways that you will be issuing shares to an employee. Now, again, looking back at COVID, we do have a situation where there's a lot of people that are owed money. We have a lot of people that might owe money, and we need to figure out how do you recover those debts. And by now, they might be becoming quite old, and by now they might be becoming bad debts. So there's 2 ways to collect a debt, primarily. Number 1 is that if it's undisputed, that means you sold a good, they've received that good, and after they received that good, they've sent you an email and they said, you know, I'm so sorry, I can't pay you. I'll pay you back when I can. They've just admitted the debt, you've issued the good, they've received the good, they've admitted liability. You can now issue what's called a statutory demand. Now, statutory demand is pursuant to the Corporations Act. It's deemed issuing legal proceedings. It's normally issued by a lawyer because it's very technical, and it's only issued in circumstances where there's no genuine dispute, there's no right to set off, there's no counterclaim, and it's generally admitted. And in those circumstances, a lawyer can issue what's called a stat demand. And once they issue it, the other side has 21 days to pay or file an application to the Supreme Court or federal court to set it aside. So if they don't pay and if they don't file a claim in court, then they commit an act of insolvency, and it gives you the right to proceed to appoint an administrator or liquidator to immediately wind up their company, and then get that liquidator to sell the assets, sell the business, recoup the proceeds, and pay you out. But that, again, is very technical, and if you issue it and it's defective, you can be liable for their legal costs if they file a claim in court to set it aside. The other way to do it is by issuing a letter of demand. Now, LawPath has template letter of demands in their document, in your dashboard, and they have the initial letter of demand, they have the second one and third one. So the first one's obviously a nice one saying, look, we know you might have forgot to pay your debts, but this is a gentle reminder. The second one is, we want payment within 7 days. And then the third one is, we're going to issue legal proceedings against you. So normally, if you want to be able to recover your legal costs against the other side, then you normally would give them notice that you're going to issue legal proceedings first, and that's why you would be issuing the letter of demand. Now, once you issue the letter of demand, the next step is to issue legal proceedings in court if you have not issued or if you have not been paid. And if it's a claim for a commercial matter that's generally under around 10,000, then you can normally go to your local magistrate's court or your local court, New South Wales local court, magistrate court, Queensland, Victoria, or you can go to NCAT, QCAT, VCAT, which is the New South Wales Civil and Administrative Tribunal. And that tribunal is made for people to recover debts generally without lawyers. If it's a small debt, you're normally not allowed to have a lawyer. And if you are allowed to have a lawyer, then you can't recover legal costs. So I always recommend, when it's a small claim, to consider going to your local tribunal, because it's actually made for individuals who run cases on their own. The rules of evidence doesn't apply. It's not as formal as court. And normally the members there will give you some guidance on how to run your case. There's also good videos on how to do it as well. You know, in VCAT, they have good videos showing you a step-by-step process of how to appear in the tribunal and so on. Now, let's say, for instance, you have got a lot of debtors. You don't want to actually issue legal proceedings. You know that people don't have any money, but you just want to tighten up your procedures. There's several different ways for you to do that right now. And that is that you issue your invoices when you do your work. A lot of people will run an end of the month billing, but if you were to finish a job on the 2nd of the month, and then you don't actually issue your invoice until the 30th of the month, and then you have 30-day terms, you won't actually find out that you're not going to get paid for 2 months. So I always say it's important to issue your invoice once you've done your job. The second one is there's no requirement for you to have a 30 or 60-day due date on your invoice. A lot of people put 30 days because they think that's industry standard. It depends on what industry you're in, but 30 days is a long time. And again, you won't know whether a debtor is not paying you until that date passes. So my recommendation to you is to change your payment dates to 7 to 14 days. If you get pushback from someone, great. That's fine. You can negotiate it. You can change to 7 to 14 days. Or you can change it to 14 days to 21 days, or you can change to 21 days to 30 days. But I do recommend you consider reducing your payment terms in a situation where you've had debt in the past. Consider taking payment in advance. If you're able to do that, take a deposit. Break up your services into separate stages so that you know if they're not going to pay one invoice, you can suspend your works immediately, and they will likely be in breach of their contract. If you can, take a personal guarantee from the director. Again, a PTY LTD, you're entering into business with a company. If they've done corporate structuring, that company might not have any assets at all. You might render service to that company. That company might already have a bunch of debts, and you might never get paid. If you get a personal guarantee, you have a lot better chance of getting paid. Industry standard, it's different. If you're in the construction industry and you're offering goods, standard practices get a guarantee because construction companies normally don't have a lot of assets, and they are also normally, there's a lot of them that go into liquidation because of cash flow issues. If you have a lawyer, you can ask your lawyer to take trust deposits. That's not that common, but depending on your industry, it might be something that you can consider. We do what's called escrow. So that is, we'll take some money in advance, but we're not going to hold it. We'll have this third party hold it. And once we render our invoice, then we'll get them to release the money to us. And remember that the squeaky wheel gets the oil. So if you are having debtors, it's likely that there's a lot of other people that they owe money to. So if you're the one that complains first, they might deal with you before they deal with everybody else. And have another look at, even though COVID, I would say it's post-COVID. I think we're in the 53 days without a case in New South Wales, but it doesn't mean that it might not come back. So if you have contracts, consider changing and putting in a COVID or pandemic provision into your agreement to allow you to extend your time for your services. Have a look at your business interruption insurance as well. Now, if it's the other way around and you are actually in a lot of trouble and you actually owe a lot of money and you don't know what to do, and you're in a situation where you owe $100,000, your business owes $100,000, you know that if you can just pay out that $100,000, you would be able to successfully continue on trading, and you have a lot of work coming up, then you might be able to enter into a deed of company arrangement. And what that deed of company arrangement essentially is it's saying to the creditors, look, there's 10 of you, you each owe $10,000, we owe $100,000. I'm sorry, but we can't pay the $100,000. If you all come after us, we're going to have to close down our business. You're not going to get anything. So I'm happy to tip in $50,000 that I borrowed from my friends and family, and I'll put that money into a fund. And if you guys all agree to this, taking 50 cents on the dollar, then we'll sign off on this document. You all get paid out 50 cents, and then that company comes out clean with no debt. So this is called a deed of company arrangement. It's a binding agreement on all creditors. And basically what you do is you put an administrator in, you get the director to propose a deed of company arrangement. It's basically proposed for the purpose of being able to continue running your business. And then if the creditors vote in favor of it, then all creditors are bound by it, and you pay the creditors out X amount of cents on the dollar. And then from there, you come out with no debt. And that's about it. So the purpose of this was really just to let you know about the different structures, how to issue shares to your employees, and to know that these kind of things exist. So if you think it's suitable to your business, then I recommend you consider doing the asset protection, looking at the corporate structuring, and reviewing your terms so that you can get your debts reduced or recovered, and to prevent them from happening in the future. Now, if anyone has any questions, we'll take those now. If you found this interesting or you liked it, make sure you give us a thumbs up, make sure you share, and I will wait to see if there's any questions. All right, well, thank you very much for everybody joining. I will sign off now. Enjoy your week and have a good weekend.